Well, good afternoon, everyone. My name is Aaron Kavanaugh. I am with the Kaza Group of EXP Realty, and my partner Corey and I are here today with our friend Cheree Warrick. We are here to talk about STR, or short-term rental financing, and how to get that done depending on where you are with all of your incomes and things like that. So, just a quick little intro. My name is Aaron Kavanaugh. I've been a real estate agent for 23 years. I have focused solely on short-term rentals since COVID, and so far this year we're rocking and rolling. It's been pretty busy, especially with all the things in the economy that's going on. Corey, give us a little 5-second rundown about who you are, what you've been up to, and what you do.
Yep, I'm going to keep it brief because I do have folks cutting wood and hammering away up here. I've been investing for about 18 years. Have a portfolio of multifamily properties, single family properties, and then 3.5, 4 years ago, started jumping into the the single short-term rental space. Uh, saw the profits that were coming in on short-term rentals and kind of went full steam ahead with that. So kind of nice now. I've got my own properties. I've got properties that I manage for others. I do coaching and consulting with short-term rentals. Uh, Great to have Cheree on the call. Always love hearing and meeting from another lender in the space because
Yeah, Cherie,
all
give us
lenders
a
are
little.
different and they all have different options available for you.
Yeah. So, Sheree, give us a little rundown. We call you the money lady.
Yes, hello. I am the money lady. Cheree is my name. And I work with a lot of investors with regard to helping you build your portfolio. And within portfolios, there usually cash flow and appreciation that you're looking to get. And short-term rentals are interesting because I feel like there's an opportunity for all three of those based on if it's managed right. And being a part of Erin and Corey and the Stream Network is a great way for you to maximize all three of those. So I'm happy to be here.
Yeah. So we have a little, Sheree and I have done this once before, a couple times probably, but we just have this little
Mhm.
routine that we kind of run through. So, Sheree, honestly, I know that you do a lot of different types of loans. We'll get into, obviously cash is not lending, but that's an option for investors if they are
Yeah.
interested in going in that direction. You also do hard money loans. Is that correct?
Yes, we have access to hard money loans as well as other types of loans that are out there. And I am licensed in 8 states. So
Wow, that's
help with
awesome.
that as
Okay,
well.
cool.
Mhm.
Yeah, so just to be brief about the different types of lending that I see coming through the lines, and it always depends on the lender and what their
Mhm.
options are, but there are three
Mhm.
types. The first and the easiest loan potentially is the second home or vacation home loan, where the down payment requirement is very low. 10% down payment, but there are some rules and regulations that go along with that. So, Sheree, can you give us a little idea of what a 10% or a second home loan like look like?
Yeah, and I will take a step back and say that it's not necessarily the easiest, it's just a choice and a decision. And that is based on a few different factors. So people will say that they want a lower down payment. So they want to do 10% down, and you can do that with a second home loan. I will say this though, this is the issue. If you do not have high income, then this is not the loan for you. The reason for that is this 10% down payment, second home loan. There are two specific things that affect it. Number one is it is a conventional loan. So they're going to look at your income and they're going to look at your debt, and you have to be within a certain threshold in order for you to be approved. The second is that um, they cannot and will not count the expected rental income for the property. So Sometimes when you are looking at conventional loans and you hear about investor conventional loans, we are able to count the long-term rental income only, not short-term rental income. But for second home loans, you have to be able to afford that mortgage on your own. Another question that people ask me is, I don't own my primary home. Can I get this loan? And the answer is yes, you can. So some people live in New York or Jersey or places like that where they may not own their primary home, but you can get a second home loan through this.
Awesome. Okay.
Mhm.
And quick regulations. Have to live in the house for 2 weeks out of the year, something like that.
Yeah, I say that. So the regulations or the guidelines don't say like a specific number of days. I think they used to, but they, recently it hasn't said that because I went back and checked. But they do say that you have to have access to the property. So it cannot be a long-term rental. The other thing is it has to be something that can be used year round. So, I would say Antarctica, but, they're not going to fund in some place where the property cannot be used year round. So that's a couple of the things which, make short-term rentals, especially in the Shenandoah area, Massanutten, places where Erin is located, that makes it so great, is because people are using it in the winter, summer, all the seasons.
I have a quick question. So you mentioned in the beginning, it's good for high income earners. Can you define relative? I know it's all relative, right?
It's all relative.
Where that threshold might be. And the second question, it probably tails a little bit on that first one, is from my understanding, not only do you need to be able to carry the loan on the property that you're buying as a vacation rental, you also need to carry the mortgage on any primary
That is
residence that you
correct.
currently have, right? So you essentially need to
Yes.
be able to carry every mortgage that you have in addition to the one that you're looking to purchase as a vacation rental. And I think
That
that's
is correct.
probably where you come in with this is for high income people because you need to be able to carry the different mortgages.
Yes. So because we have a lot of investors that we work with, I will say that if the property is if you have a portfolio of properties and the others are investment properties, but this one you're wanting to purchase now will be a second home loan, we can again count that rental income. We are going to be looking at your taxes though. So if you have a CPA that loves to expense everything on your taxes, I could get complicated, but just understand that that there are certain things, certain protocols you need to have. But your first question is, how much do I have to make? The answer is it depends on your debt that's on your credit report, right? So if you just have your primary home loan and you want to get this second home and you don't have student loans and car notes and things like that, you might be able to make 100,000 or 150,000 household income or by yourself and be fine. If you have a lot of extra stuff, then your income needs to rise proportionately.
And
And it also depends on the kind of house that you want to buy as well for the short-term rental income. You buying a $200,000 house or you buying a $900,000 house?
Sure.
That makes a difference.
And the investment properties that you already own, the banks, again, from my understanding, I did this a while ago and then I switched to DSCR, so I don't need to worry about this as much. But when I was buying properties, the banks that I was using, they would look at my rental income from the properties, but they would only take like 75% of that income. They would deduct a certain
Yes,
percentage off the top.
so if it is an investment loan, then yes, they would only take 75% of your expected long-term rental income. If it is the 10% loan that Erin is talking about, they will not take or count any revenue from it. And then just to make it a little bit more complicated, if you already own investment properties and you've owned them for 2 years or more, they're going to look at your taxes in order to figure out if those investment properties are profitable. So,
cool. So before we move on to the next type of loan, does anybody have a question for Cheree or Corey or I in reference to a second home loan or 10% down payment?
I'm surprised no one asked about minimum credit score.
So yeah, that's a great point. So Cheree, give us that. I also know one quick thing that, if you're going after a second home, there is a rule that you have to be at least 60 miles away from your current residence. So you can't just buy your next door neighbor's house and use that as your vacation property.
Yeah, so it's 50 miles away.
Got it.
50
Cool.
miles away. And it is minimum credit is 640.
Okay.
So for you to get a conventional loan, minimum credit is 640. And the rates right now, because people always ask about that as well, anywhere from 7% to 8%
Okay.
is what we're seeing.
Still
So
pretty much normal from what I've seen over the last year or so.
yeah, it's pretty much normal. You'll have a slightly higher interest rate than your primary home. And the reason for that is because, it's slightly riskier for
Lower
you
down
and for the
payment.
bank.
Yeah, lower down
Yeah.
payment.
Yeah.
Cool.
So
All right, Cheree, give us the goods. All right, so you've got a regular conventional loan, 20% investor loan. Can you buy an STR with this?
yes, you can. However, when we are looking at getting you approved, again, for a conventional loan, 20% down, when we're looking at getting you approved, they will not use the short-term rental expected income. They will only use the long-term rental expected income. So again, it's one of those things that it's better if you have a certain amount of income for you to be able to get the conventional loan.
So just a quick question as you go through that. So if I were to rent this particular property, let's say it's hypothetically $2,000 a month in regular rental income, right? And then with an STR, it's potentially $4,000 in rental income. They're only going to calculate that number based on the 2,000 per month. Is that correct?
And then they're going to use 75% of the $2,000.
Understood. Cool.
So you will need to have enough income and low enough debts so that you can pay for your primary home as well as your the difference, that 25% differential between your mortgage, between the expected rental income and the mortgage that they're giving.
Got it.
So
cool.
The great thing though about the conventional loans is that you probably will get more cash flow because the conventional loans are looking just at the long-term rental income and not the short-term rental income when deciding to give you that loan. So,
okay.
But you will have to provide pay stubs and all of that stuff. So
fabulous. Cool. All right. So, obviously lending, for these types of properties is what it is, right? So we just have specific guidelines that we have to follow. Real quick, Corey, I know that you like to play in the investors space. So give us an idea of, just what you're seeing from a seller finance, maybe a different perspective on that, just to kind of switch it up a little bit.
You're gonna have to get back to me because they're cutting wood right now.
Okay, we'll come back to you.
Okay,
all right, cool. That's fine. And so, Cheree, what's the next
Yes.
one that we really talk about all the time? I think it's DSCR. Is that correct?
DSCR, fancy term, stands for debt service coverage ratio, but it's a super simple concept. The concept is that if the rental income can pay for the mortgage, and you usually have to have about a 660 credit score or higher, then you're practically approved for the loan. And I'll always have to say practically because things could happen in appraisal and title and all of that stuff, right? But that's the gist of the DSCR loan. So you may say, well, Cheree, why would I choose a DSCR loan versus a conventional loan? Well, the DSCR loans could be anywhere from 15% down payment to 35% down payment, right? It depends on the down payment percentages, depend on where you're purchasing the property. If you're purchasing in a city or a suburb, is closer to the lower end, 15, 20, maybe 25%. If you're purchasing in a rural or remote area, you're looking more 25, 30, 35%. Okay. So you may say, well, you know what? I only want to put 20% down, but I want to buy in an area where Erin is. Therefore, I'm going to go the conventional route. I'm going to manage this property for a couple of years, get really good earnings, and then refinance to a DSCR loan in a couple of years. So you could do that as well. But the DSCR loans are what they will do is they will have the appraiser go out and appraise the property, not only for the value of the property, but also look at air DNA or, you know, the other forecast methods of short-term rentals. And they will say, based on what we're seeing, the comps, things like that, we expect this property to bring in X number of dollars per month. And that is what the lender is going to use in order to give you an offer for that property.
Okay. Sounds good. Yeah. So
Mhm.
Cheree, let me ask real quick. So as you know, I'm going through a transaction right now, and the buyer did come and speak to you about the lending process and then decided to go with a different lender. Well, now we're having appraisal issues, not for the value, but for the condition of the property. So give us a little heads up as to what we could expect or what you might have seen in the past in reference to something like that, like condition of the property.
Yeah, I mean, you know, the question, a couple of things that I've seen for the appraisal, the question is, sometimes the lender will say this property cannot be zoned rural in order for you to get certain kinds of financing. So I see that a lot. The other is, you know, is the property habitable? You know, things like that within the appraisal and the home inspection
Yeah, so
reports
this
that
house
we're
in
seeing.
particular was actually in beautiful condition. It's renting currently. It's making some decent money, but there was a little roof issue, and it was
Okay.
clearly seen in the home inspection, clearly seen by the appraiser, and so he put a requirement that before they went to closing, the roof needed to be repaired. So
I've seen that.
so what is your thoughts and all that? Just kind of give everybody just in case scenario.
Yeah, I mean, I think that you would have to run your own numbers based on how the appraisal comes back. I did have a client once who was buying an investment property, and the appraiser saw some cracks in the foundation, and they were required to fix those. So within the appraisal, it'll say, well, I forgot the exact term for it, but it'll say that this appraisal is, you know, conditions based on XYZ, whatever the appraiser sees. And then you would make those repairs, and you have to do a reappraisal. So basically, the appraiser has to go back and verify that those repairs were done, and they submit that information to the underwriter before you can get the ability to close that loan. But, you know, with regards to the roof or anything like that, most of the time the appraisers are looking for things that are pretty serious and pretty obvious. They're not looking for, you know, the wall is green instead of blue, right?
That gets tricky, right? With
It does get tricky.
sorry,
Yeah.
I'm jumping in because I have a quiet moment. So,
Yeah.
but it gets tricky there with the repairs that need to be done because you technically haven't bought the property yet. And sometimes the seller will not want to do the repairs. They'll want you to pay for the repairs. And you haven't bought the property yet. So they might not want to commit to doing the repairs for whatever reason. So you got to work through that, right? Which is
Yeah.
why,
Yeah.
you have Erin on your side, right? To
Yeah, I
kind
was
of
just gonna
negotiate
say,
through that because it does get tricky.
yeah, to make
Yeah.
sure you have the right partners in place, right? So you have to have a good contractor. You have to have a realtor that's been through this once or twice before, maybe, you know, and an
Yeah.
experienced loan officer because, you know, it's a delicate dance and frustrations can rise. And if you have the right people in your corner, it becomes so simple right? It doesn't need to be a bigger deal than anything that it should be. So
Yeah, I mean, I used to always ask the underwriters, "Hey, can we do a repair escrow?" And I've never gotten it accepted. They're always like, "Nope,
nope.
this
Yeah.
needs to be repaired, or we're not closing on the property."
I
So
wonder who those people are because they probably do not sleep well at night.
I don't know.
They're usually pretty cranky, I'm telling you. Anyway,
Yeah.
Corey, give us a little gist on you if you got a second in reference to those seller finance opportunities.
Sure. I'll go real quick.
Just general, very general.
General, right? So, seller finance is great for somebody who is in a situation where they want to get out of the property, right? Maybe they want to sell for more than the property's worth. They want to get a little bit more money. So there are ways to work the deal. Cheree, I don't know how in depth you get with the sub two stuff. Well,
I know about the sub two stuff. I mean,
yeah.
I
It's
can tell people overall about it.
It's a little
Yes.
tricky, right? But it can be done.
Mhm.
Seller financing, I think, is a good option for the owners and the sellers that are open to it. Not everybody is because it's a little bit longer for them to get their money back. However, if it is pitched the right way, they actually wind up making more money in the end, right? Like I've done seller financing to people before that I've sold properties to, and literally make hundreds of thousands of dollars more on a property doing it that way than doing a traditional loan because you can also ask more for the property because if they're asking for seller financing, that might be the only way that they can get into the deal, right? They might not be able to get approved by a bank. They might not have the down payment. So you can work something out on a creative side where as a seller, it will put more money in your pocket. As a buyer, you still make sure you run the numbers and make it work so that you will cash flow on the property. So it's a win-win for both people.
Yeah. Yeah. And so, when we talk about, seller financing, terms are always negotiable, right? So it's something there, but most importantly is to think about, a couple of things like the title companies or the legal representation that can write up those types of loans for you. It's basically a mortgage deed, right? So 5, 10, 15, 20%, whatever the terms are that you guys come to an agreement on, the length of time that the property can be into this seller finance thing, as well as potentially balloon notes and final payments within 5 years or something like that. And the things that we see with investment properties is somebody bought a house, hypothetically, they have some kind of issue, and if they were to put it back on the regular market, they're now having to bring multiple thousands of dollars to the table, and it just didn't work, right? So this is where we would come in, find that person and say, listen, we have an opportunity for you. It's a 5% down payment or 25% down payment, whatever the down payment is, 5%, percentage rate. And then you will get your money back after, a certain period of time. And so, that lends itself. Corey and I just did one of those. The title company was heavily involved in making sure that the paperwork was all straight, was very well described through. So everyone knew exactly what they were getting. The buyer was extremely happy because he actually got a lower interest rate than the regular mortgage rates. The seller was happy because he was still getting residual incomes from those mortgage payments, and he was getting a higher number down the line. Because right now that property would not have appraised for the value that we purchased it at. So
Yeah, so it's nice when with in terms of like relating to short-term rentals, right? There are people who have bought short-term rentals that are just bad operators, right? Like they bought the property, the numbers should work, the operator can't make it work, and they want out. They figure this is not for them. So if you're able to work out a seller financing deal where that guy originally thought he
Mhm.
was going to make money on the property, you can essentially work something out where not only is he going to make the money to cover his mortgage, but he's going to make a little bit more on top through seller financing. He's making the money that he always wanted to on the property. He doesn't own it. You come in as a good operator and you're making above and beyond what you're paying for that mortgage and what you're paying to the seller. So you win on that deal all day long.
yeah,
Now, they're not, I don't suggest you try to go out there and negotiate that with a seller on your own.
no,
Are a lot of ins and outs and a lot of things to think about on these deals. Most important, aside from The real estate agent or the lending person, but you might not need a lending person in that situation, is the right title company, because not every title company is going to be versed on how to navigate these steps as well. And even when you bring it up to a title company, most of them will sit there, like most people who are looking for a sale will do, and say, yeah, we can handle that. And then you get halfway through the process and they're like, we don't know what we're doing. Like, we can't figure this out. We can't do this. And you're like, well, I brought this up to you in the beginning. And well, I didn't understand this and that. I mean, it happens all the time. So you got to be careful about who you're working with. Everybody's out there trying to make a buck, right? So everybody's going to say yes to you up front. We can do this. And then as you start to get down the road, some things are going to happen that start to raise red flags, and you realize you're in way deep, and this isn't the person you want to be partnered up with.
Right.
Absolutely.
I agree
Absolutely.
with that. I mean, the title company can actually make or break your deal. So, speaking or contacting Erin or Corey or somebody within Grid and say who's an investor-friendly title company that has a lot of experience, with any kind of seller financing deals like this.
Yeah. And so, so there's another way to handle this. Corey, you've done a couple of sub twos. Can you give us just a high level description of what a sub two is and what it might be?
Sure. I'm gonna try and just move inside real quick. Give me 1 sec.
Sure. So just for everybody's sake, Corey is a property manager and he's helping a new investor set up his cabin in Moorfield, West Virginia. So he's there with contractors today.
Little noisy.
We're gonna
Yeah.
want a tour.
Yeah, it's cool.
It's a nice property. Goes up. There's a
It's
loft,
very nice.
and then you can't.
Oh
see
yeah,
it
big
because of the glare,
windows.
but
Oh,
that-
I love that. Look
that
at the
looks-
mountains.
you get an endless view out there. I mean, just to the mountains. It's great. Very nice property. This property. So Moorfield, West Virginia, good STR market. This property is a 3-bedroom, 3 bathroom, I think. But it'll do 85,000 over the course of the year gross, right? And then you have to pay everybody out.
Yeah.
What'd you ask me? Sub two?
Sub two. Give us an idea what your deal is on sub two.
So the deal on sub two is they're tricky. It's a little gray zone. I'll call it a gray zone. Some people are like, yeah, let's go, let's do them. Other people are like, no way, I'm going to stay away from them. Real estate, bring it up to a real estate agent, and they're going to be like, most real estate agents will be like, what are you talking about? Like, that can't be done. It's not allowed. I'm not going to get paid. So they're just tricky. You're essentially taking over. You're not involving a lender. You don't want to involve the lender at all. You don't want to talk to the bank that the seller has in place already. So the seller has a mortgage. They have a balance due on the property. They're making monthly payments. What you're essentially doing at a high level is taking over that seller's mortgage payments. And then there's going to be a gap, right? So if they owe $150,000 on the property and their monthly mortgage payments are $1,000, but they want to sell you the property for 400,000, right? You're going to give them some sort of down payment, or if you get a really sweet deal, right, you don't need to put anything down. And then you're going to take over the $150,000 principal that's left on the $1,000 mortgage, and you're going to do a seller financing option where they're going to loan to you that other, what was my math? $250,000, right? At an agreed upon interest rate with agreed upon terms. You're going to get a third party debt servicing company in there that's going to take the payments from you and then disperse them to both the bank and to the seller. You don't want to handle those transactions on yourself, because then the bank could call the note due, or it's more likely that they would call it due. There's a lot involved in them. You want to get a transaction coordinator. You want to make sure you have the right title company, and most agents that you're going to call and bring this up to, they're going to be like, you're nuts. You don't know what you're talking about. I'm on to the next person. And they won't even talk. Most of the time, they won't even talk to the buyer about, or to the seller about it.
Yeah. And it's one of those, so as an agent that understands investment properties, not just short-term rentals, but investment properties, there is a few layers of information that we might know that others may not. And I'm not saying that they're fools by any stretch of the imagination, but it's truly who you work with matters, right? And if you don't understand the sub two situation, things like that, or seller finance, do not even attempt it, because these are where you can lose your license. You could get into all kinds of trouble. So, when we talk about short-term rental financing, the only reason I'm bringing these up is because they happen, right? They do happen in this game. And so 90% of the opportunities that you're seeing are going to go through a mortgage lender, just like Cheree, the three ways we mentioned, 10% down payment, 20% scenario, and then the DSCR. Okay. The other two options are, very risky. Like Corey mentioned, on a sub 2, that loan could be called at any moment, but the benefit to the buyer is that they're getting a lower interest rate versus what's out there today, right? Seller financing, people could get upset with one another even though they have a contract, and then there's other types of problems versus a bank, and somebody doesn't have that. So Cheree, you had a question.
Yes, so for the sub 2, I'm going to make a statement and then I'm going to ask my question to Corey. I would imagine, as a person who my name is on that mortgage, that I would want to make sure, darn sure, that you can actually pay that mortgage, whether or not the property is rented out that month, etc. In your experience, Corey, what are sellers doing? Are they looking at credit? Are they requiring a certain additional amount of money in escrow? What are sellers doing in order to protect themselves from somebody who may run out of money or be a bad operator?
Yeah, loaded question, right?
It's
What
not a
are
loaded
sellers,
question.
what are sellers doing, or what sellers should be doing, right? I mean, there, right? There are
But
sellers
you
out
know,
there.
so what are they doing? If they're not doing anything, then that says a lot as well.
It's a lot as well, right? Yeah, you should be running a credit check, right? You should be looking at the reserves that the person has, how experienced they are, do they have other properties in their portfolio? Um, Take a look at a criminal background, right? I mean, it's something you want to take a look at. You want to know who you're getting in bed with. And, if the guy has felonies for embezzlement, um, might not want to do the
Might
deal,
not be the guy you want to
right?
invest with.
Uh, you should also be getting the right real estate attorney to draw this stuff up so that you're protected, so that you can foreclose on the loan if it needs to be done. However, if it's set up properly, you should also have there should be somebody in between that is essentially hooked you up with the deal, right? And their involvement in there is like I have a property that I did a deal with somebody on, and if that person stops paying the mortgage, well, I'm going to step up to the plate as the owner of the property. I am going to continue to pay on that mortgage, right? Uh, Even though he owns the properties on the deed. Now, if he stops paying that portion, I will then foreclose on the property, because then, assuming he's not paying my portion either, even if he is, I could still foreclose on the property due to the legal paperwork that we have drawn up so that I can foreclose and take the property back from him. Right. But there's a lot of ins and outs. It does get very complicated. You want an attorney, you want somebody who knows what they're talking about, you want the right real estate title company to get the deal done for you. There are
Yeah.
also transaction coordinators that get involved in this because they are very, very versed in sub 2 deals, more so than title companies, more so than the buyers and sellers, and they know all the I's to dot and all the T's to cross on that type of transaction.
Yeah. So one other quick thing. So, when we are talking about purchasing short-term rentals, obviously there's a lot of questions up front that people go through. So, down payment requirements are one. The second one is very, very important, is actually what the closing costs are. And Cheree, you and I have gone through this over and over and over again, and interest rates
Yes.
are one huge piece of this conversation, but give us
Mm-hmm.
a little insight as to what the closing costs, kind of,
Mm-hmm.
what people should be looking for within their closing costs. Obviously, you're going to give them a good faith estimate and make sure that they understand where everything is, but give us an idea of what
Mm-hmm.
closing costs kind of look like.
Sure. So, a trainer of mine, when I first got into lending, gave me the acronym Delta, like the airlines. And Delta for closing costs means down payment, escrow, lender fees, title fees, appraisal.
Hmm.
So when we're looking at how much money you need to bring to the closing table, that's, that's a very good acronym to start with. We are looking anywhere, I want to say, I've been quoting a lot of like $20,000 to $30,000 closing costs lately. Some of it will depend on where you're buying and how high the taxes are. And then depending on the kind of loan you're getting, you're going to, for your escrow, that's your prepayment of your taxes and your insurance. You're paying anywhere from 12 to 15 months in advance for that as well. And
Okay.
just so people know, basically, I tell people escrow is like a savings account where the bank will, or the lender will have you put a certain amount of money in that little quote unquote savings account, your escrow account. And then when your taxes and insurance are due, the lender actually pays that directly. And then every month you make your mortgage payment, you're paying into that escrow account as well. So they're the ones that keep up with your taxes and insurance. I know I gave a lot of additional information, but
No,
that
that's good.
delta for the closing costs is a very easy way for you to do a rough calculation of what your closing costs would be.
Is there a to make it easy, and I know it's
Mhm.
not easy because there's a ton of variables in there, as you just said with the
Mhm.
delta. Is there a rough range of a percentage that you can say people should estimate on closing costs, whether it be 3 to 5, 2 to 4?
Yeah, I've heard the 2 to 4 plus the down payment.
Okay.
So I'll be honest with you, I haven't done the math myself. So,
Okay. I was just
at
curious if you,
some point,
yeah.
I might do the math myself and see if I actually agree with that 2 to 4%, but that's what I've
Right.
heard.
Yeah,
And the
and
other question that you said something about money in escrow. I don't know why it triggered me on this, but
Mhm.
going back to the vacation rental loans real quick,
Mhm.
I'm going to throw out a term out there that some people might have heard of, some people might have not. Do those kind of loans require any sort of reserves for people to have? They
No,
don't. Okay.
no.
So reserves, so the DSCR, the loans though, typically do require a certain amount of reserves. And what reserves are
Yes.
basically, depending on the bank that you go with, they might want to see X number of months of mortgage payments in the bank somewhere that you have access to, not like a 401k. Although they could use whatever you can take out on a loan without penalty on the 401k. But depending on the DSCR lender, also, Cheree, correct me if I'm wrong, it would be either looking at the reserves for just that one property, or they would look at the reserves that you have for all your mortgages combined and want that in a reserve account.
Yeah, I've seen both. I want to say I've seen more often where they will look at every property that you own that's on your credit report, and say that as well, that's on
Yep.
your credit report, and want to make sure that you have enough liquidity for all of those properties. And
Right.
I
So,
will say this as well. So this is where we start talking advanced level building your portfolio.
yep.
There are times when you want to do a conventional loan or you want to do a certain loan and you don't care if it's on your credit report. And then there are other times where it may be worth it for you to pay the extra half a point of interest to not have it on your credit report because you're trying to make some other moves in your life.
Right. So,
So
so essentially, if you have $5,000 in mortgages between your
mhm,
primary and this DSCR property that you're buying,
mhm,
typically, I've seen anywhere from like 6 months to a year. But if
mhm.
that's a year, the bank wants to see $60,000 of cash reserves, and that's cash reserves after you've closed.
After
So
after
if
the
you
closing.
can't
Mhm.
count that, oh, well, this is my down payment. I'm going to put this down, but that was
Nope,
my reserves. No, you've got
nope.
to have, if it's $150,000 down, you've got to have $210,000 available for your 150 down. Doesn't include closing costs, so you want to pay that
Mhm.
as well. And then you need a 60 on the back end sitting in an account somewhere, depending on the lender also. And I don't want to get too far in the weeds. Depending on who the lender is, that money might need to be seasoned or not seasoned, right? So that means the money needs to have been in an account for a certain period of time. You can't just call up Uncle Mike and say, hey, can you throw $75,000 over to my account, because they just want to see that I have the money there. There are banks that that's okay with when you start to get into the commercial world. However, most of them want to see the money that's been seasoned and it's been sitting in that account or anywhere 2 months.
For the most part, I've seen 2 months, and that means that the beginning balance
Yep.
for 2 months needs to have that number as well as the ending balance.
Cool.
Mhm.
Wow, we're learning a lot today. I actually learned something in that, Cheree. I didn't know
Yeah.
delta was a term, but that's cool. I like that.
I like it too. Makes it
Yeah,
super
that's cool.
simple.
All right, so I have two more things to talk
Mhm.
about in reference to
Mhm.
mortgage lending and purchasing power with this. When we talk about seller credits,
Mhm.
most agents only understand that seller credits are only based on what they call closing costs, right?
Mhm.
So each loan
It only
has
goes
its
towards closing
own.
costs.
Yeah. So
Mhm.
each credit can be a maximum of, and each type of loan has a certain limit that you can ask for. So,
Mhm.
for example, in an FHA loan, you can only ask for how much in total credits towards closing costs.
I don't know that off the top of my my
Okay.
head.
Yeah. So yeah, it's 3%, right?
Yeah. So
It's
yeah,
3% because
it's
they
three
don't want
percent
it
if
to be
it's mhm.
higher than the down payment that you're putting in, right?
Right.
In
I
a
know it for the
conventional
conventional.
loan, it can be
Mhm.
up to 6% of the thing, but you actually have to use all of the funds from the closing costs to get all of the cash, right? A buyer cannot receive a check. So
Mm-mm.
say your closing costs
Right.
only come out to 3%, like we talked about, right? And then there's additional 3% sitting there. That check does not go to the buyer, right? It just comes off the top. So, or to benefit of the seller as far as the net is concerned. So give us a little idea as to, if we're asking for credits, what are your opinions on that, and how do I
Yeah.
apply that?
Yeah. So I want to go back to, so I know the conventional numbers, and yes,
Yeah,
it's 6% because you're putting 10% down. So,
correct.
if you're buying a primary home and you're putting less down, the numbers are different, right?
Sure.
Okay. Just want to make sure. Um, okay.
Yeah.
So, you are able to take that money in order to pay towards closing costs and to buy down your rate as well. So it's basically called a rate buy down. And you can either buy the rate down temporarily or permanently, but I'm like, why buy it down temporarily? Doesn't make any
Yeah.
sense. The other thing is if you don't use it, you lose it, right? So basically, if you don't use the entire 6%, then you cannot transfer it, like Erin was saying, to HIP National Bank, meaning your pocket, or to the down payment or anything like that. So there have been times with clients where we've finagled, like, hey, we've got more money in credits than we have closing costs, and we've bought down people's rates with the rest of that money. They've given
Yeah,
them some
I've
savings
seen
that way.
things simple as, paying HOA fees for multiple years in advance, paying insurance for multiple
Mhm.
years in advance. The big one is obviously buying the rate, doing that one
Mhm.
is huge, right? So, as far as seller credits are concerned, the legal way is maximum number based on the loan type. Each lender will tell you what that max number is, and then being able to use that cash, the
Mhm.
actuality of using that cash.
Mhm.
So that's all I want to bring up is a lot of people talk about seller credits and stuff like that, but that's, you can't use it for repairs. You can't, the lenders are going to require certain things to be
Right.
done with that funding.
Right. I do want to also say that the 6% number is for conventional loans. There sometimes are caps of 2%, maximum 2% for certain investment loans. So if you are planning to negotiate seller concessions, asking your lender before you negotiate them is going to be the best way to go.
Yeah.
If you are thinking, oh, I only want to, because one of the things from an investment point of view, you think about cash on cash return. So if you're like, look, for me to achieve my portfolio goals, I don't want to put any more than X number of dollars total into this property, then, hey, so that way we want to, or for that reason, we want to negotiate some seller credits, just making sure you talk with us, because we may have to put you into one product versus another, or put you with one lender versus another because of that.
Yeah. So by the way, the reason Cheree mentions that is she's a mortgage broker. So she can
Yes.
go to multiple companies to find you the best potential deal out there for this particular property that you're looking at. All right.
Yes.
So
Yes.
one last question. Thank you, Cheree. That's always a question I get is, can I ask for credits? Can I make them pay for repairs, whatever, stuff like that? So the last one is ownership. I have this question happen to me all the time. So I'm going to buy this house. I want to put it into an LLC, or I want to have some kind of structure that's going to protect me and my family from insurance claims, whatever. Is there, if you're using a certain type of loan, can you use an LLC? What is the rules behind that? So either
Okay.
one of you, if you want to answer that, that's helpful.
So the rule is this: if you are doing the vacation home loan, that second home loan, that's 10% down, or you're doing a conventional loan for the investment property, you cannot close in an LLC. So this is where competing interests
Cannot close.
cannot close in an LLC. Yes, yes. This is where competing interests sometimes lie, right? Where you want to close in an LLC and you want to get a lower down payment and you want to get the lowest interest rate, et cetera. Sometimes I have to say, you got to pick what's most important to you, and you don't want it on your credit report, et cetera. So, but yes, it cannot close in an LLC. If it's a DSCR loan, we have some lenders require you to close it in an LLC. So you don't have a choice the other way, because we've had people come and say, I want to do a DSCR loan, but I want to do it in my own name. Well, I have certain lenders that will not let you do that. Right. So,
I use
yeah.
like the lender that I've went to for DSCR. There's 5 states in the country where they require you to be in a LLC. And then the other states, they don't care if you do it in your own name. I think it's like Virginia. I want to say Virginia, Georgia, Massachusetts. I don't remember the other 2, but there's 5 states where they require you to be in an LLC. The other ones, they don't care.
Yeah.
Cool.
And that has to do with liability. You are getting this as an investment property, and the lenders, the people that are giving you the money, want to make sure that they're like, hey, we said Corey wasn't going to live here because he closed it in his LLC and, he signed all this documentation. So that's their thought processes around that.
Now, I did emphasize
so-
the close thing, but you
Mhm.
you can kind of, you can correct me on this.
You can.
After you close on the deal, right, in your personal
Mhm.
name, you can then do a quick deed transfer into an LLC after the deal is already closed if you're looking for the protection.
I will say that it
Kind
can
of.
trigger a due on sale clause because you've
Hit
technically
it?
transferred
Okay.
the title. So just know that that can happen. Yes. But
Cheree, would you explain that, what you just said?
the due on sale clause,
Yes.
yes. So I'm sorry.
Yes,
Okay.
please.
Okay. So yeah. So a due on sale clause basically means that if the property is transferred or sold, and every loan that's out there has this in it, right? If it's transferred or sold, the lender can technically come to you and say, hey, you transferred this property from Corey D's name to, Corey D LLC. Give us our money back. This is how much you owe for your balance, right? That can technically happen. Every investor that I've spoken with, everybody that I know, it's like 99% of the time, as long as you're continuing to make payments, you're not going to get that call or that letter or anything like that. But there's always the 1%. And there have been situations where, the due on sale clause has happened.
Gotcha.
And there
Hey,
are
Cheree,
ways
so
to, there are ways to like, but it's a long process, right? So there are ways to like reverse out of it and kind of work around what they're asking. You can put the loan back into your name, right? Because
You
then the
can,
loan's back in
or
your
you
name,
could just refinance.
or you can
You
refinance.
could
There's different things
refinance
to do.
into a DSCR loan officially.
Yeah.
So.
yeah.
Mhm,
So Cheree, in the comments, in the
mhm,
texts here, there's a question from Orlando.
mhm.
Can you partner up with an SDIRA?
Okay, so SDIRA stands for
Self-directed IRA.
directed,
Self-directed
yes,
IRA.
IRA. So just explaining to people what a self-directed IRA is. It is basically a retirement account where you are able to invest in anything you want, including real estate. I think you invest in crypto, you can invest in notes, things like that. And it's usually attached to a checkbook, right? So just like you would write a check from Bank of America account, you could write a check from these IRA, self-directed IRA accounts. So just letting everybody know what that is. The answer is yes, if. So I'm going to say for a conventional loan, I don't know if you can. But I have worked with someone on the DSCR side. Yes, if it is something called a non-recourse loan. Usually, your self-directed IRAs require you to connect with a lender who does a non-recourse loan. And you may say, well, what is that? A recourse loan is if Corey defaults on his property, and we foreclose on it and we auction it off as the lender, and there's still $100,000 due after we auction off that property, we can go after other assets that Corey has. That's called recourse. A non-recourse loan is if Corey defaults and we, as the lender, auction off the property and there's $100,000 still due, and we cannot, non-recourse, we cannot go after any other assets that Corey has. So the reason these self-directed IRAs want it like that is because if Corey had another $100,000 in his IRA, they don't want the lender going and attaching that 100,000, that a lien against his retirement funds. So you'll have to ask your IRA team about that, and if they require a non-recourse loan. Like I said, I've worked with people who that was a requirement, and we had to find a lender that said yes to that. So
The other trick
can it be
about
done?
the
Yes.
the other trick about the self-directed IRAs is you can't manage that property. You can't stay in that property. You can't have anything to do with that property. It is essentially a 401k. You can't take the money from the property, right? As far as I know, you can't do anything. Like that property is completely off limits to you. You have nothing to do with it. None of that money flows into your bank account. It's all completely separate. If you're asking about the SDIRA, you probably already know that. But for people who don't know about SDIRAs, that is the case. You are completely hands off. You cannot touch that property at all.
That's interesting. I didn't know you could manage the property, but that's interesting.
Yeah. All right, cool. So we've talked about a lot of things here, folks.
Mhm.
There has to be some additional questions. We got into a couple of really tight conversations about
Yes.
certain things too that don't normally happen in regular financing. So I'm sure there's questions. We've got about 5 minutes left. So anybody want to raise their hand and give us something? We did a good job, Cheree.
I think so. I think
Okay.
so.
All right, so let's just to recap. Cheree,
Yes.
Warrick, you're with
Mhm.
who?
I am with Simply Funded, and we are here. I'm the money lady, so we're here to help you with regards to building your portfolio and leveraging and maximizing the best lending options possible. And I'd love to help you.
Yeah. So I met Cheree through our real estate team, but what I know
Mhm.
about Cheree is her previous job in this world was a SBA administrative type loan person. So if you just
Mhm.
have any financial questions, she's super smart, dude, and you really want to pick up the phone and call her. So anyway, Corey, give us a little recap. Thank you so much for being here. What is your final thoughts on investments or financing for STRs?
If you're going to get involved in any of it, don't do it on your own. you got to talk
Yeah,
to the right people. I mean, there are people out there doing it on their own. I do it on my own. But you've got to have some experience in doing this stuff because it does get tricky and you can get burned and you don't want to get yourself into legal trouble either, right?
for sure. For sure. I think that's the biggest key is like, some of the things that we've started talking about, like sub two, which is an option in some cases, but you can get yourself into trouble if you don't know all the rules behind it and what can, because it could be called due on sale at that moment in time whenever the bank finds out about it. So, all right, cool. And I'm a, full-time real estate agent. My first and most important job is to connect you with the right people. Um, I consider myself as an agent, yes, but I am a matchmaker personally. I try to hook people up with Cheree and Corey at the right moment in time to discuss the right options for them in their investment journey. Um, for me, writing a contract is not just about writing a contract, it's finding the right property, doing the projections, finding the right loan type that it makes sense all the way through for someone. And if you're a new investor, it may be this direction. If you're an experienced investor like Corey, he knows some ins and outs of things. And, I may not choose to get involved with some of it because it is what it is, right? There's a deal that has to be done between the owner and the buyer. So we just understand the rules when it comes to buying any investment property, whether it's, hard money loans to, cash and all of that. So if you have questions about it, our contact information is right there. We really appreciate your time today. And you guys could go have a great afternoon. Talk to you.
Thank you, everybody.